Hello and welcome back. We're going to give Statement of Comprehensive Income another chance. We have a different question paper here, and this is the information that we are given. We have the telephone account for February 2023, 12,500 had been received but not yet paid. This just means that we received our statement from our telephone service provider. We owe 12,500 for February. That is what we have used. We have consumed telephone benefits, but we haven't paid them yet. We need to add on to our existing telephone the 12,500. It's 145,100. There is your 12,500. The second adjustment says insurance expense for the financial year amounted to 88,200. The total amount of premiums that fall in our financial year, that match our financial year. The matching concept, it says that incomes are recorded when they are earned and expenses are recorded when they are incurred. There you have your 88,200, and we have subtracted whatever amount that we needed to take out of the 96,450 to get our insurance for the year. Next, we have the bookkeeper forgot to reverse the income received in advance at the start of the year for fee income. Remember, at the end of the financial year, what we do is we match our incomes and expenses with our financial year, and that gives rise to things like income received in advance, prepaid expenses, accrued income, and so forth. Now we are in the next financial year. We have income received in advance. It makes sense that before we take into account any other fee income that we're going to receive in the financial year, we need to account for the one that we received in advance from the previous year. So this financial year is the year that we are going to earn the income from fee income. We received it without earning it. So to reverse income received in advance, what we're really just saying is that this year is the year that we're going to recognize it as fee income because we would have earned it. From our extract, we are given that our income received in advance is 4,000 Rand. Next, we have a service was done for a cash customer in February 2023. The customer showed proof of payment to the technicians, but no entry was made in the books of the business. On investigation, it was discovered that the payment never went through Mazibuko Solutions, and Mazibuko Solution Ltd is still owed the fee of 6,000 Rand. Since the transaction was not recorded to start off with, for the statement of comprehensive income, we need to record a fee income of 6,000 Rand. We have earned this income. And for the statement of financial position, we will record 6,000 Rand as accrued income. But we're not doing that. So we'll just record 6,000 Rand under fee income. There you go. There's your 4,000 Rand. This is the fee income that the bookkeeper forgot to reverse. And there's your 6,000 Rand. Next, we have the tenant miscalculated the annual increase and overpaid the February rent by 2,500 Rand. We have not earned this 2,500. We have not yet provided rental benefits to this person. We are going to do that in March. What we need to do is to remove the 2,500 because it does not form part of our financial year. Rent income, there you have your 2,500 subtracted from our rental income. So this is income received in advance. The bank statement was downloaded on 28 February and following still needs to be recorded by the company. Bank charges 2,500, interest on current account 12,600. An EFT payment of 85,000 Rands for a 4-month advertising contract which was started on 1 February 2023. So what this means is that we have paid for advertising services for 4 months, February, March, April, and May. But our financial year ends in February and we're only concerned with recording incomes and expenses that fall in our financial year. I've quickly worked out the amount. We have 85,000 divided by 4. That will give us 21,250 per month. So we need to take out the 3 months, 3 times 21,250. So there you have your 2,500 added to bank charges. And then if you look at your interest incomes here, down here, there's that 12,600 added onto interest incomes. And lastly, we have our advertising expense, 21,250 added. Remember, Advertising is $21,250 per month, and we only consumed advertising benefits for February, which falls in our financial year. The other 3 months are in the next financial year. These amounts in the brackets are 85,000 rands for 4 months. Subtract from that 63,750. If you work it out, it's 21,250 multiplied by 3 months. Next, we have the loan is repaid in 8 equal annual installments on 1 September 2022. The company made the first loan installment payment. The loan repayment and the interest on loan have been correctly recorded. This adjustment has nothing to do with our statement of comprehensive income because they've already calculated interest expense on our behalf. The next adjustment reads as follows. A debtor claimed that a 5 kVA model had been installed and he had been charged for 8 kVA. It was agreed to grant him an allowance of 9,500. Allowance is an accounting term for returns. If someone made a return, we call that an allowance. Debtors' allowances means debtors who returned their stuff. So allowances are subtracted from sales in the statement of comprehensive income. If you remember, when we are doing closing transfers, what we do is close the debtors' allowances to sales first. Before we subtract this 9,500 from our sales amounts, let's check if we have debtors allowances from our extracts. There you go. We have debtors allowances of 393,250, which also needs to be subtracted from our sales figure. And there you have it, 393,250. That is our debtors allowances. And then you have 9,500 rands, which is what we granted that debtor who said we charged them for the wrong model. I just want to quickly add, if it was a return, if this 9,500 was a return from the debtor, they had actually bought, for example, an 8 kV model and they returned it, they're like, I don't like this model. We would also need to subtract the cost of that from cost of sales. This is because cost of sales is an account we use to track the cost of goods sold. So when someone returns the stuff that they have bought, we also need to take the cost of that item that they returned from our cost of sales. In this activity, we're not going to do that because this 9,500 is not an actual return of goods. They did not bring back the 8 kV model to us. We charged them for a higher model than the one that they bought, and we are simply just trying to reverse that part where we charge them more. Tato Transistors, who is both a customer and a supplier, so there's intra-trading. Tato Transistors was overpaid. We were paying them in the capacity of them being our creditor. Remember the T accounts I'm using here. They are meant to help you visualize what would happen when you are doing this transfer. This is not how you record this in the books of a business. You are going to use the general journal to record this transfer. But in the exam, you can make use of 2 T accounts. One, Tato in the capacity of a debtor, and then the other one, Tato in the capacity of a creditor. So what we initially started off with is a debit balance in the creditor's account of Tato. We overpaid, so whatever we owe them, we don't owe them anymore. In fact, they now have a debit balance because of that overpayment. What we're going to do is we want to transfer this out of their creditor's account. We want to create a net of 0. Well, how can we do that? We can just do a credit entry to give this account a net of 0. Remember, for every debit, there must be a credit. For every credit, there must be a debit. So that credit will have a debit entry in the debtor's account of Tato. The net effect is that we are going to debit debtor's control, which Tato would be inside debtor's control amongst other debtors. And we are also going to credit creditor's control. Tato in the capacity of a creditor will be there amongst other creditors. This adjustment does not directly affect the statement of comprehensive income unless you are given a percentage to calculate your provision for bad debts at the end of the year. You would need the debtor's control balance to do that. In this case, we don't need to do anything for our statement of comprehensive income because we are given the provision for bad debts at the end of the year. Moving on, provision for bad debts must be adjusted to 529,215. Remember, statement of comprehensive income, we put provision for bad debts adjustment. not provision for bad debts. Provision for bad debts is an account we create to estimate the amount of debtors that are going to go bad. These debtors have not yet gone bad. We are estimating that this amount of debtors are going to go bad. And what happens at the end of the year is that we revise our estimations. If you look here at the end of the year, we have adjusted provision for bad debts to be 529,215. But we did not start off with that provision for bad debts. We started off with how much? There you have it. This is what we estimated at the beginning of the year, that debtors worth of 617,750 will go bad. If what we started off with at the beginning of the year is more than what we ended up with at the end of the year, then we have a provision for bad debts adjustment as an expense. If the provision for bad debts that we started off with at the beginning of the year is more than the provision for bad debts at the end of the year, then we have a provision for bad debts adjustment that is an income. Why is this an income? Well, you can think of it this way. We thought more debtors were going to go bad at the beginning of the year, but now at the end of the year, upon revision, we think less debtors are going to go bad, right? So you can think of it like some sort of a gain. If it's the other way around, the provision for bad debts that we started off with at the beginning of the year is much less than the provision for bad debts that we end up with at the end of the year. What we are saying is that more of our debtors, we are estimating that they're going to go bad. What we started off with is not enough. We need to add on to that because we think more than that is going to go bad. That's not a good thing. You don't want your debtors to go bad. So the provision that we started off with at the end of the year, 617,750, is more than what we ended up with, which is a good thing. We are saying that less of our debtors are going to go bad now. And that good thing is an income. If you put provision for bad debts on your statement of comprehensive income, you are going to lose marks. They're going to subtract marks for foreign items on your statement of comprehensive income. Remember, adjustment. The next set of adjustments, we are given some ratios which affect inventories. These two adjustments, 11.1 and 11.2, have to do with the questions that were related to the statement of financial position because we are given our trading stock deficit. If we were not given the trading stock deficit, then they would affect our statement of comprehensive income because we would need to work out what is our trading stock balances. Next, we have, it was discovered that an employee had stolen 15,000 worth of diesel, which is a consumable store, in February. This was not insured and it has not been recorded. So there are two things that are going to arise here. Number one, that 15,000 rand, we're never going to see it ever again. It was not insured. We can't go back and pump out the diesel from this person. It's gone. We lost it, right? So for that, we need to create an expense account to recognize the loss of 15,000 rand that we're never going to recover. We will have loss due to theft, an expense, loss due to theft, 15,000 rand. The second part, we need to think about consumable stores. If we move up our information and we look at consumable stores on the extract that we're given, it says that consumable stores is 299,000 rand. That's not true. 15,000 was stolen. We as the business did not make use of that 15,000 rand. So we need to remove it from that 299. The second adjustment that is going to affect our consumable stores is the next adjustment. The physical stock count on 28 February revealed that 23,000 worth of consumable stores were on hand. Consumable stores is an expense account. If we leave consumable stores as this amount, 299, what we would be saying is that we consumed diesel worth of 299,000 rand. And that is not true because we have diesel left over, unconsumed diesel. So consumable stores on hand is unused consumables at the end of the year. We need to remove them from our expense account in the statement of comprehensive income because we did not use them. They're still here in the business, right? If you have a look at our consumable stores, there's your 299. From that, we subtracted what was stolen because we as a business did not consume those consumables, and 23,000 rands that was left over. We are going to consume this in the next financial year. So we need to remove it because we did not consume it this year. And then if you look here, you have your loss due to theft, 15,000 rand. There's no way we ever going to recover this, so we need to expense it. Trading stock deficit, we are given the trading stock deficit in this example. Sometimes you will be required to calculate the trading stock deficit yourself. And we've done all our adjustments, so you just rewrite everything that wasn't affected by adjustments. And this is what they wanted you to do with your statement of comprehensive income for this paper. And lastly, you just calculate your tax for the year, 30%, and they've given you the net profit before tax.